Thank you, Mr. Chairman. Madam Secretary, thank you for being here today. Mr. Chairman, I'd like to enter for the record an article from Tax Notes titled Gain and Little Pain from New Bermuda Corporate Tax.
Without objection.
Thank you. Madam Secretary, as you might be aware, Bermuda is introducing its new corporate income tax that will take effect in 2025. Bermuda entities will be able to mark up their intangible assets to their estimated market value, and under the new law, they can amortize those assets over 10 years for tax purposes. Madam Secretary, this creation of a new deferred tax asset also results in a deferred tax expense. As you know, under general guidelines provided by the OECD for Pillar 2 that you negotiated, deferred tax expense or these amortized deductions will not trigger minimum tax liability that could be imposed by other globe participating countries. Bermuda has no intention of giving up its ability to attract business through the tax code. Other countries are adopting similar measures to maintain their status as an attractive jurisdiction at the expense of United States multinationals. We know about Singapore, we know about Ireland, the things they're doing to maintain their ability to use their tax code to lure companies there. Madam Secretary, are you concerned about the fact that Pillar 2 is creating a new tax subsidy race where countries enact Pillar 2 taxes but offset the higher tax costs with tax subsidies in the form of qualified refundable tax credits and other incentives like what Bermuda is doing?
Well, the idea of Pillar 2 is to level the playing field, and countries that refuse to raise their corporate tax rate up to the minimum, countries that participate and enact the minimum can, in effect, tax companies in tax havens that haven't done it. You've cited an example. I'm not aware that this is something that's broad-based, but if it is, it would certainly concern me, and it's something that I'd be prepared to look into.
Well, Madam Secretary, we've all seen what Ireland has said about putting a cap on recurring revenues. We've seen what Singapore has said in refundable tax credits. We've seen what China does in direct tax payments or direct access or cash payments to their companies to be able to offset the taxable income, so that they, in effect, from the look at it, that the minimum tax level would be hit, but companies in those countries are getting subsidies through direct credits that offset that, take it backwards, where ours aren't direct. Ours are not refundable. We have to actually earn income to be able to utilize those. Question 2, is this administration concerned that Pillar 2 incentivizes subsidy warfare that puts our adversaries like China at a competitive advantage?
It would concern me if it's incented that, but I'm not aware that that is broad-based at this point. And in our case, many of our tax credits, such as the green tax credits, the LIHTC credit, are being treated as refundable. As I've emphasized previously, we're working to make sure that the R&D tax credit also will be something that firms can
But Madam Secretary, I think you just validated that countries have the ability to make certain credits refundable to offset the minimum tax that other countries or OECD can lay claim to. China can do it. I think you're going there, evidence the fact that they're not always transparent in what they do, since all of their companies are basically owned by the CCP. Madam Secretary, I just want to talk about, I've got a longer question here, but it pertains to the same thing. I think there's a lot of work to be done. As you know, the Republicans on the committee went to the OECD and expressed our concern and made it very clear that Pillar 2 is not going to take place under a Republican-led Ways and Means Committee. We're not going to give away our tax dollars. In fact, it's said time and time again about how many tax dollars, the U.S. taxpayer dollars, would go around the world, upwards of $200 billion. I know you said that was JCT's outward look, but I think it's important for everyone to know, and you know this to be certain. Corporations don't pay taxes. The people that work for the corporations, the consumers of the products of those corporations, and the owners of those corporations pay the taxes to increase pricing for whatever the commodities are. In fact, Forbes, Brookings, Tax Foundation, Cato, and many, many others have said that consumers pay 31% of the new taxes, workers pay 38% of the taxes, all of those people, for the most part, make less than $400,000 a year. So they're going, about 70% of the tax increase will be paid by people making less than $400,000 a year, some portion of that. So I think it's disingenuous, as my colleague from Pennsylvania said, to say that no one is going to pay a single cent, as outlined in the White House's conversation about policy going forward. It's just disingenuous. It's not factual, and it's not honest with the American people. One other thing that you said is that the labor participation rate was better today than it was pre-COVID. I know you selectively picked an area.
For adults.
It was 63.3% on March 2020. Today it's 62.7%. Overall workforce, when you don't have the luxury as an employer, as I did for 35 years, say, I'm only going to hire people working, you've got to be 25 years old or 54 years old.
We have an aging population, and as people retire, we know that labor force participation overall will decline over time.
Mr. Chair, you're back.
Thank you.